Hello everyone, we are going to talk about the book One Up on Wall Street. If you invest in stock or thinking to invest, this is a must-read book for you. This book written by Peter Lynch. He was the manager of the Magellan Fund at Fidelity Investment between 1977 and 1990. His average annual return was 29.2%, making it the best performing mutual fund in the world. This is the most practical investment book. The book consists of 3 sections. The first one, an introduction to invest and develop of an investor mind. The second one, step-by-step process to pick stock. And the last one, long-term view to invest and portfolio. Know what you own and know why you own it. Peter Lynch. Here is Cuan Group present the book review.
And I will explain to you about chapter 1 till chapter 4 of this amazing book, One Up on Wall Street. It's about the making of a stockkeeper. Throughout the 50s and the 90s, not only in America, but also in Peter Lynch family and relations, there was widespread distrust on the stock market. Almost everyone warned him against investing in the stock market. Peter's first job was a caddy on a golf course where he overheard presidents and CEOs discussing their successful investment, prompting him to reconsider his family belief that the stock market was a place to waste money. He caddied throughout high school and at Boston College. Peter purchased his first stock in 1963 and it soared 5-fold in less than 2 years, allowing him to fund his graduate studies at Wharton Business School. He earned a summer internship at Fidelity, which was the highest performing investment house at the time, during his senior year in Boston. He was also assigned to research, write reports, and visit firms in the same way that professional analysts were. Chapter 2 is about the Wall Street oxymorons. Most professional and institutional investors have an advantage over individual and amateur investors. Cultural, legal, and societal hurdles stifle fund manager in the majority of cases. Many people are stymied by a plethora of written laws and regulations. Some banks, trust departments will simply not allow stock purchases in any firms or unions, while others will not invest in non-growth industries or certain industry groups such as electric utilities, oil, or steel. Some funds are further restricted by a market capitalization rule, which states that they cannot own stock in any firm with a market values of less than $100 million. However, there are a few funds managers or investors with little or no constraints, such as John Templeton, Warren Buffett, and Peter Lynch, to mention a few who have a long track record of success. Under the existing approach, a stock isn't truly attractive to many major institutional professional investors until it is widely known. A number of significant institutions have acknowledged its suitability, and an equal number of credible Wall Street experts have placed it on the recommended list. Many pension funds, for example, are only permitted to purchase stocks from a pre-approved list. Is this gambling or what? Said Peter Lynch in the chapter 3 of the book. It's crucial to know the distinction between debt investing and stock or company investing. Investing in bonds, money market, and CDs are all types of debts for which interest is paid. Debt instruments have historically yielded fewer than 5% return. You're nothing more than the nearest source of spare change when it comes to bonds. The best you can expect for when lending your money to someone is to get it back plus interest. Stock investing is clearly more profitable than debt investing. Since 1927, the average annual return on common stock has been 9.8%. Investing in stocks offers limitless potential because you are a partner in a growing and successful company. Bonds are less risky than stocks. There are numerous businesses that have vanished from the list. A company fortune shift, and there is no guarantee that huge corporation will not become tiny. You will lose a lot of money if you buy the right stock at the wrong moment and at the wrong price. Chapter 4 is about passing the mirror test. Before you buy a share of any company, there are three personal issues that ought to be addressed. The first one is, do I own a house? The second one is, do I need the money? And the third one is, do I have the personal qualities that will bring me success in stocks?
So, this is me, Christianti. I will share about chapter 5 to 8 from the book One Up on Wall Street by Peter Lynch. Chapter 5, questioning about is this a good market? Thousands of people, including professionals, technical analysts, gold experts, macroeconomists, and forecasters try to predict the market, but they haven't been able to with any useful consistency. So, pick the right stocks and the market will take care of itself. Invest in companies, not in the stock market. Moving on to stocking the 10 bagger. It is important that you invest in companies you are able to understand and give you the edge. The person with the edge is always in a position to outguess the person without an edge. If you are in the business or industry, you have a double edge as you will know the customer liking as well when not to buy the particular company. So invest in the things that you know about. If you get it, what's next? Once you have established the size of the company relative to others in a particular industry, you can place it on one out of the 6 general categories: slow growers, stalwarts, fast growers, cyclical, asset plays, and turnaround. Growth companies are expanding in more sales, more production, and more profits in each successive year. If you have the perfect stock, what a deal! It is much easier to develop a company if its business is simpler and easier to understand, like drug companies and chemicals companies that have niches, products that no one else allowed to make, and the products that people have to keep buying it. Rather invest in the toy company, you have to invest in the company that makes drugs, soft drinks, razor blades. It's useful in daily life. Instead of investing in a company that makes automatic scanners, why not invest in the supermarket that use the scanners? If a scanner helps supermarket company cut 3%, that alone might double the company's earnings. And lastly, the insiders are the buyers, because there is only one reason why the insiders buy the stock, because they think the stock price is undervalued and will eventually go up. Also, the company is buying back shares. When stock is bought by the company, it is taken out of circulation, therefore shrinking the number of outstanding shares. This can have a magical effect on earning per share, which in turn has a magical effect on the stock price. If a company buys back half its shares and its overall earnings stay the same, the earnings per share have just doubled. That's all about chapter 5 to 8, and moving on to the next chapter.
Hi, I am Erin Marcella. Today I would like to share you about the book review, and I'm going to explain for the chapter 9 until 12. So for the chapter 9, we talk about stocks I'd avoid. So I will give you some insight about the this book. So the first line or the first line is we review about the hottest stock in the hottest industry. So this is a stock everyone gets to hear about. The hot stocks go up fast, but when price falls, it falls steeply too. Most people buy because others are buying it with a hope that price will rise sharply soon. But don't think so, because if you had to live off the profits from investing in the hottest stock, each successive hot industry, soon you'd be on welfare. So we are moved to the next paragraph that I will review. It's about the beware the next something. So another stock I'll avoid is a stock in company that been tortured as the next IBM, the next McDonald's, the next Intel, or the next Disney, and etc. In my experience, the next of something almost never is. And we move to the avoid diversifications. We talk about the value of the shareholders is lost when the company overpays for the acquisitions, and when the acquisitions are completely beyond their realm of understanding. And most of all, in most cases, buying back shares or rising dividends is a better way or options than acquisitions. Why? Because here I will give you the tips and tricks. So the trick is to find the right acquisitions in related business and manage successfully. We move to the next paragraph. It's about the beware the whisper stock. So from time to time, people will tell you about a company that they think will be a great investment, a good company with a good investment or with a good stock. But in another side, we have to think about the opportunity. Most likely, they have been telling about this company to every other person, and those are whisper took a stock with hypnotic effect and a psychology appeal. So it's not only a good company with a good opportunity, but we have to know more about the company itself, the growth on the financial, and also the news related to the company. If the good company, but on the other hand, the news is not good with the company itself, related to the company, it will be not good to the opportunity on the stocks. So you have to know more about the company, and not only from the recommended from other people who tells about this company is good, but you have to digging more informations about the company before you buy stock. Now we move to the next paragraph. It's beware the middleman. So the company that sells 20 until 50% of its wares to a single customer is a precarious situation. So if the loss of one customer will be catastrophic to a supplier, I will be very I will be wary of investing in the supplier. So we next to the beware the stock with the exciting name. So as often as a dull name in a good company keeps early buyers away, a flashy name in mediocre company attracts investor and gives them a false sense of security. So as long as it has advanced, leading, micro, or something with an X in it, or it's a mystifying acronym, people will fall in love with it. So that's my review to chapter 9. So we move to the chapter 10. So chapter 10 will talk about earnings. So what is it about? So here I will give you some explanations and review about the chapter 10. So what makes company valuable and why it will be more valuable tomorrow is earning and assets. So especially earnings, sometimes it takes years for the stock price to catch up to a company's value, but sooner or later value always win, right? Because on these days value is number one. So yeah, when you analyze a company on the basis of earnings and assets, it is no different from buying an apartment, drugstores, or McDonald's franchise. Supposed to be when we buy something like McDonald's franchise, we talk about the value, how much the value that I will get, right? So it is important to remember that a share of stock, it is a part of ownership, not lottery ticket. So when you buy a stock from the company, you must see and review and analyze the company's assets and finance, and the most important is value itself, because when you buy stock, you have some sense of belonging or ownership of that company, right? So the net asset is a book value after subtracting all liabilities from the asset. But if the company is not liquidated and sold off to the creditors, the value of the company comes from its assets, and mostly the capacity to earn income, right? So the next step is to put company on these 6 categories discussed in the chapter 7 that previous: slow grower, stalwarts, and fast growers. So when you buy stock in a fast growing company, you are really betting on its chance to earn more money in the future, right? And when earnings are up, stock price is up. So before we go to the stock value, we have to know about the finance analysis of the company, like the asset, the liquidity, and else. So here's I will give you some tips or the review how we see the finance analysis. The first, we go to the PE ratio. So the PE ratio is a relationship between the stock price and the earning of the company. Useful measure of the whether any stocks is overpriced, fairly priced, or underpriced relative to a company's money-making potentials. Not only that, the PE ratio, when we use the PE ratio, it's calculated as a current price or earning price per share for the prior 12 months or annual year or fiscal year. So can be thought the number of years it will take the company to earn back the amount of your initial investment. A ratio of 10 means the original investment will be earned back in 10 years. Not only that, the PE level, we have to see the PE level to be lowest or for the slow growers and highest for the fast growers. And first step could be to look up to the PE ratios of various stocks you own or looking to own are low, high, or average relative to the industry norms. So if you remember nothing else but the PE ratio, remember to avoid stocks with excessively high ones. Why? Because you will save yourself a lot of drift and a lot of money if you do. And with a few exceptions, an extremely high PE ratio is a handicap to a stock, and in the same way that extra weight in the saddle is a handicap to a racehorse. So that's all from the PE ratio. We must look for the future earnings. So when we analyze the finance, not only the PE ratio, we have to know the future earnings of that company. So it's the best way to educate guests based on the current earnings. Not only that, you need to try and project what's going to happen to earnings in the next month, the next years, on the next fiscal year. Earnings are supposed to grow, and every stock price carries with it a built growth assumption. And if you cannot predict future earnings, at least you can find out how a company plans to increase its earning. Then you can check periodically to see if the plans are working out. So there are there are 5 basic ways a company can increase earnings. So the first one, reduce cost. The second one, rise price. The third one, expand into the new world or into the new field and all new markets. So sell more of its products in the old markets to old or existing customers. And the last one is to revitalize, close, or otherwise dispose of the losing operations. So that's all from the chapter 10 about the earnings. So remember that before we talk about the chapter 9, that stocks that I would avoid, that why we have to see stocks that have to avoid, because it's related to the chapter 10 that a good company is not always have a good opportunities. So how come we know that company will have a good result or good stocks? So we have to know about the assets, earnings, and the current asset, and also the liquidity with the PE ratio and the future earnings. Now we move to the chapter 11. We'll talk about the 2-minute drill. So what is it about in chapter 11? I will more explain and maybe give a little tips and trick about this. So first step is to know whether you are dealing with a fast grower or a slow grower or a stalwart, a turnaround or an asset pay. So remember the PE ratio, right? So and the PE ratio has given you a rough idea or whether the stock or currently price is undervalued or overvalued. So the next step is to learn as much as possible about the company and what is going on to bring out about the added prosperity. This is not about the story, so you have to know about the story behind the company, about not only the current situations, not only about the current conditions. You have to digging more about finance news related to the company, mostly to the IPO company. So might be it's about the acquisitions itself or why their stocks value going up or going on. It must be related to the activities of its company. So before you buy a stock, you should be able to give a 2-minute monologue that covers the reason you are interested. So when you see the company, you will like to buy the stocks. You have to know your reason itself, why you want to buy that stock, not only from the recommendations of others, but you have to convince yourself and prepare yourself if the stocks might be in the future the stock is going low or going high. So yeah, you have to know the reason to yourself why you have to buy this company stocks. What has to happen for the company's success and the pitfalls to stand at its path. So here's some examples for 2 minutes monologue, like slow grower, focus on dividends. So focus on the dividend, like this company has increased earnings every year for the last 10. It offers an attractive yield. It's never reduced or suspended a dividend. And in fact, it raised the dividend during good times and bad, including the last 3 recessions. And also its telephone utility and the new cellular operations might add a substantial kicker to the grower rate. So after this slow grower, we can give a cyclical. It's like focus on business conditions, inventories, and also prices. There has been, like for example, there has been a 3-year business slump in the audio industry, for example. But this year things have turned around. I know that because car sales are I know because that the car sales are up across the board for the first time in the recent memory. So something like that. So the first is slow grower. The second one is cyclical at the mostly for the growing up of the company, and the third one is asset play. Asset play is focused on assets and how much they worth to the stocks, right? And the fourth one is turn around, focus on how the company gone about improving its fortunes, and it's the plan working so far. And the next, or the fifth, is stalwarts, is focus on PE ratio. Don't forget to analyze the PE ratio and whether the stock had a dramatic run up in price in recent months, and what if anything has happened to accelerate the grow up on the stocks. The last one is fast grower. So what fast grower focus on how it plans to continue to grow fast. So the more you know better. In many cases, you need to devote for several hours or days to develop a script to convince yourself and make the analyze about the company, such as the finance, the asset, and also the stocks itself. Now we're moving to the chapter 12. Chapter 12 is talking more about the getting in facts. So getting the facts that the company and also the stocks itself. So rumors are usually more exciting, but as an investor, the rumors is not enough. For the investor, rumors have to get the right fact to convince that the stock is good. But and on the other hand, the investor, you need to focus on getting the facts right. So annual report and quarterly report are the best resources for facts. So what you can get from the annual report you can get asking your broker, by calling the company, by visiting the company, or visiting the company website. It's when it comes to the company the IPO company, they are very, very open to the annual report, their CSR activities, and also the news related to the company. Also knowing the kickings of its tires. So the first one is as I mentioned previous, when you want to know more about the fact of the company from the annual report, getting more the annual report by the broker. So getting the most out of broker, because broker know everything from that company. So if your broker recommends a stock as your brokers about a category of stock, like 5 types, slow grower, fast grower, cyclical, and turn around, a recent growing in earning and PE ratio relative to the history itself. And the second one is calling the company. You can also calling the company to know about the company itself, the current conditions, or whether you calling the company and directly want to talk about the company, or directly want to talk with the C level or the manager level. You have to prepare the specific questions. The investor relations office is a good place to get the answer, but you have to prepare the question itself. Before you call, don't forget to prepare the questions, because all you are trying to do is to get a reaction to whatever script you have been trying to develop. It always better that you lead off with a questions that shows you have done some research development on your own, such as I see on the last annual report that you reduced that by 500 million, something like that. You have to know the history of the company, and also have the prepare questions. So on the other hand, not only calling the company, you can also visiting the company or the headquarters, meeting with the investor relations, and attending annual meetings are other ways to get more information. On one other way you can also get to know the one of employee or the one of the investor relations. It more insightful to know the information from their companies, right? So after you calling the company, you can also reading the reports like annual reports or the news. So there's no better resources other than annual reports, right? So when you see the annual report, what have you have to look out? So I will give you the tips and tricks. So the first one, you have to see the balance sheet of the company on the financials. So check the cash and marketable securities in the current asset sections. If together it exceeds long-term debt in the long-term liability sections, it's very favorable. No matter what happens, the company isn't about to go out of business. So assume other current assets, including receivable inventories and other current assets, are valuable enough to cover short-term debt. And in the balance sheet, you have to see if the long-term debt exceeds the cash has been shrinking and debt has been growing. The company is in weak financial shape, so you have to know about that. More like analyzing the balance sheets. So check whether the shares outstanding has been reduced in the last 10 years or increased. So buying back share leads to an increase in earning per share and thus the share price. So that's all from my my insight. So that's all from my book review on chapter 9 until chapter 12. So don't forget, when you buy stocks, don't forget to see the company. First, you have to see the company. Is it possible or not? I mean, like, is it possible you buy with this price? Why the price is high? Why the price is low? For example, like, it is a good company. Why they sell on the stocks with the low stocks, low price? You have to know, you have to dig in more about the company. First about the company, and you have to check the annual report. After you got the annual report on the website, you can get it on the website itself. After you have the annual report, you have to see the balance sheet of the company. You have to check the financial. You have to check the PE ratio and asset and the liquidity itself. So don't just buy the stock when the company is good and the price is high. So you have to see also the opportunity itself. So that's all from my my insight and tips and tricks. Thank you.
Chapter 13, some famous number. Here and any particular order of importance are various number worth to know, like percent of sales. If you are interested in company because of a particular product, the first thing you want to know is what the product means to the company. In other words, what percentage of the sales. And then you should know about financial in terms of the price earning ratio, the debt factor, dividend, cash flow, inventory, and etc. Chapter 14 talk about rechecking the story. Every few months it's worthwhile to recheck the company story. This might involve reading the latest value line or the quarterly report and inquiring about the earning and whether the earnings are holding up as expected. Earning as expected, merchandise is still attractive. It might involve checking to the store. With fast grower, ask yourself what it will keep the growing. What pace of growth the company is in startup, expansion, or maturity? In chapter 15, talk about the final checklist. The more you know, the better. You have to study the annual report with the concentration of a Dead Sea Scholar. Some of the famous numbers apply only the specific categories of stock and otherwise can be ignored altogether. So you check the stock in general, slow growers, stalwarts, cyclicals, fast grower, turnaround, and asset plays. Some pointers from this section is understand the nature of the companies you own and the specific reason for holding the stock. By putting your stock into categories, you will have a better idea of what to expect from them. Big companies have small move, small company have a big move. Consider the size of company if you expect it to profit from specific product, but avoid hot stock in hot industry and many things you should to consider. Chapter 16 talk about designing a portfolio is part of the long-term view. It's important to expect and plan for the reasonable return. You can easily get around 8 to 10% return by investing in index funds. Therefore, you ought to be getting 12 to 15% return. Compounded over time, that's after all the costs and commission have been subtracted and all the dividend have been added. And the next question is, how many stock is too many?
Hello everyone. I want to explain chapter 17 until chapter 20. In the chapter 17 talks about the best time you buy and you sell the stock. We're going to the buy first. The best time you buy the stock is the time when you convince yourself to buy the stock. So it means that depend on yourself when you are want to buy the stock. Of course, you want to buy the stock at the lowest price. And then the second one is to stay away from the market advice and pay no attention to external economic condition. Okay, and then we move to the selling thing. So, there's plenty of the advices from this book about the selling things, but I summarize it. So this book told that when you want to sell the stock, try to judge the performance of the company, and then the second one is try to find the news that the BOD or director from that company is buy the stock or not, and then the third thing is when the company has not doing R&D or research about anything, that means that company is stuck. The companies didn't have enough money to do R&D. And then for the fourth, when the Wall Street analysts give you an advice regarding the stock. So there's of course there's a plenty of things, but I summarize it the highlight of the when you sell when the best time you sell the stock. So we move to chapter 18. Chapter 18 said the things people say about the stock price. So the things people say about the stock price is there's no one can just 100% true about the stock price in the future. So the stock price is regarding the news in the future or the information in the future. So it's still a 50-50 about the stock price. So we move to chapter 19. Chapter 19 talk about option, future, and short. Futures means that a great purpose for the investor to measure the price in the future. So and then for the option, it gives the investor to buy or sell, but not on obligation regarding the upon the price in the future. So for the shorting a stock means that borrowing stock from an owner, selling at high price, and then buy at a low price. So we finally arrive at the last chapter of this book is chapter 20. Chapter 20 again talk about the opinion. The title of the chapter 20 is the 50,000 Frenchmen can be wrong. Means that I summarize it. So we must to stay focused on our portfolio, on our company in the listed market, because there's an important thing that how I should buy this company, how I should sell this company. Just stay focused on your portfolio and trust your reasoning and judgment about the price and about the buy or sell things, and let your passion be rewarded in the future. Okay, that's all from me. Thank you for your attention and have a good day and bye bye.